Hi everyone, good evening and welcome to lecture number 3. Last lecture we started with the chapter of capital gains. We've done the basic charging section 45.1. I divided 45.1 into 3 parts: capital asset, transfer and the computation. We saw the definition of capital asset, how to determine it as short term and long term. We saw the definition of transfer, and then we went to our computation. Computation is in section 48. Section 48 gives me a basic formula, and then it has 7 provisos, 7 situations specifically highlighted which help us to understand the different situations, different variations. When is indexation allowed, when is indexation not available. Now today's lecture is a bit important because we'll be discussing many small concepts, many crucial concepts also, and I want to start today's lecture with this discussion: Vodafone case law. You might remember yesterday I had just made a passing reference, that in the definition of transfer and in the definition of capital asset, I have kept something pending. I have not discussed some things with you. Basically one paragraph. There is an explanation that is inserted in the definition of transfer. This one that you can see. This is pending for discussion. Then in the definition of capital asset, we saw there are 4 exceptions to that definition of capital asset, but then you can see after the 4th one, gold deposit certificates, there is an explanation. I have not discussed that explanation with you yesterday, discussed later on under the heading of Vodafone case law. So now that is basically what I want to discuss with you. Vodafone case law, very infamous, so many articles and videos and opinions about this Vodafone case law. It's part of your CA final syllabus. In fact, at the end of our discussion, I will be telling you how in the recently concluded November 2022 CA final exam, something relating to this Vodafone case indirectly was asked in the paper. Purely indirectly was asked in the paper. First, let's get into the facts of the case. It's a complex shareholding structure. See, there was a company by the name Hutchison SR Limited. This company was an Indian company, HEL, Hutchison SR Limited. Some of you may not be aware of this, but before Vodafone became Vodafone what it is today, it used to be owned by a company called as the brand name was Hutch, and that Hutch is this whole Hutchison SR. SR group of companies is an Indian group of companies. It owned 33% of the shares of this Hutchison SR Limited. This Hutchison SR Limited, HEL, Indian company, this was doing the telecommunication business in India. 33% was held by SR Group and the balance 67%. Now that is where the complication is, that is where the controversy is. There is a company in Hong Kong, Hutchison Telecommunication International Limited. This Hong Kong company has a 100% subsidiary, a wholly owned subsidiary in Mauritius by the name CGP Investments. For short, we'll call it as CGP. So HTIL, Hutchison Telecommunication, is in Hong Kong. It has 100% shares of CGP Mauritius. CGP Mauritius has 51.95% shares of this Hutchison SR Limited. There are also various subsidiaries of CGP, and they are also foreign subsidiaries. They own 15.05% in Hutchison SR. So this Indian company, Hutchison SR, has number 1, the SR Group as the shareholders. These foreign subsidiaries are the shareholders. and CGP Investment is the shareholder. Now what happened? If you observe in this entire thing, the case is called as Vodafone case, but so far if you understand, Vodafone is nowhere involved, nowhere mentioned only. The transaction that happened was something like this. Hutchison Telecommunication, a Hong Kong company, is selling shares to Vodafone, but shares of CGP Investments are sold. Now where is CGP Investment? Mauritius. Where is Hutchison Telecommunication? Hong Kong. Where is Vodafone? Netherlands. And the shares of CGP are sold outside India. So on the face of it, this transaction is not subject to tax in India. Seller is in Hong Kong, buyer is in Netherlands. The shares which are being sold are shares of a Mauritius company. The transaction is happening outside India. India is nowhere involved only. Income does not accrue in India directly, indirectly. Income does not accrue in India, deemed to accrue nothing. Then why this controversy? On the face of it, this appears as a transaction happening outside India between two non-residents of a capital asset, shares of CGP, which is outside India. The situation would have been much simpler if SR Group had sold its shares of HEL to Vodafone. Something like this. I am trying to think if what would have happened if SR Group would have sold shares of HEL to Vodafone, or maybe CGP Investment, it's having 51.95%. CGP Investment would have directly sold HEL ka shares to Vodafone. Basically, I am trying to think that if shares of HEL are directly sold to Vodafone, so it is shares of an Indian company. Shares of an Indian company are situated in India. As per section 9, income deemed to accrue in India, it would have been taxable in India. But that's not what happened. What happened was CGP ka shares are sold by HTIL to Vodafone. So who is Vodafone technically speaking? Vodafone is the buyer and HTIL is the seller. Now capital gain arises to the seller. So if at all any tax has to be collected, it has to be collected from the seller. Why is Vodafone as a buyer being troubled here? Because the assessing officer in India saw this transaction and sent a notice to Vodafone under section 201. Now what is section 201? Section 201 is a section where you are treated as an assessee in default for TDS, tax deducted at source. So what is the assessing officer arguing? The assessing officer is saying, Vodafone, I am giving you a notice under section 201 by telling you that there is failure to deduct tax at source, which means assessing officer is claiming that capital gains are taxable in India. Why is the assessing officer saying this? Because assessing officer is saying that when HTIL has sold CGP ka shares, by selling CGP ka shares, these shares have transferred control of this Indian company who is doing the telecommunication business to Vodafone. Through this sale, Vodafone has acquired controlling interest in HEL. Who are the shareholders of HEL? Who are the shareholders of HEL? HEL का shareholders, just a second. If you imagine HEL का balance sheet, which is an Indian company, the shareholders are CGP, foreign subsidiaries of CGP and SR Group. But when you imagine CGP का balance sheet, it has one shareholder, HTIL. And now what the assessing officer is trying to say is that HEL, which is this Indian company, which is doing the telecommunication business, of course to do business it will require assets. It is having assets in India. Now the assessing officer is saying that when HTIL sold to Vodafone shares of CGP, here the shareholder changes and now it is Vodafone. So Vodafone now controls CGP, and CGP directly and through the foreign subsidiaries controls this Indian company. So assessing officer is saying that Vodafone has acquired control of these assets. By doing this transaction, it has acquired the control of these assets, and this control is acquired indirectly. So assessing officer is saying this is why the transaction is taxable in India. Shares of CGP derive their value. Shares of CGP derive their value from the assets located in India. Right? To give you even a better way to think, I'll write one more thing. You have CGP ka balance sheet in front of you. If you think about CGP ka balance sheet, on the asset side you will have shares of HEL and shares of those foreign subsidiaries also as assets. So assessing officer is saying that when you have sold CGP ka shares, you have indirectly transferred the control of this HEL Indian company to Vodafone. Assessing officer is analyzing it very properly, very perfectly. He is correct in it. He is correct in his analysis. Earlier what used to happen? HTIL controlled CGP, CGP controlled HEL. So obviously that means that Hong Kong company HTIL indirectly is controlling the Indian company. HTIL is indirectly controlling HEL. Now what happened? HTIL went out of the picture, Vodafone came into the picture. So Vodafone controls CGP, CGP controls the Indian company. So indirectly Vodafone gets to control the Indian company. Now assessing officer therefore said, Vodafone, this transaction of sale of CGP shares is taxable in India because indirectly the control of those Indian assets has been shifted to Vodafone. Assessing officer passed this order. Vodafone went to Bombay High Court. Bombay High Court gave a judgment in favor of the assessing officer. Assessing officer is correct in saying this. That is what the Bombay High Court judgment was. So Vodafone went to Supreme Court. Supreme Court said कि Bombay High Court, your judgment is wrong. Assessing officer, you are wrong. Supreme Court ka judgment was based on the fact that at the time when the transaction took place, when the transaction actually took place, at that point of time, Income Tax Act 1961 did not have the provisions, the sections to tax capital gains indirectly like this. And so Supreme Court says that even though assessing officer is correct, but there is no section in the Income Tax Act which permits the assessing officer to do this. So Vodafone, you cannot be treated as a defaulting assessee, and this capital gain is not taxable in India. Supreme Court judgment aaya. Now it is the government's habit that whenever it loses a case, either in a High Court or a Supreme Court, and if it does not agree with the decision, not always, but if the government does not agree with the decision, then government brings about an amendment in the Income Tax Act only, which will reverse or nullify the decision. Problem. And this was a major mistake of the government. What happened? Amendment was introduced in the Income Tax Act by Finance Act 2012. But the mistake done by the government at that point of time was they introduced this amendment with retrospective effect from 1st of April 1962. 1st of April 1962 means assessment year 62-63. That is the first assessment year of Income Tax Act 1961. The amendment was required. Supreme Court had made an observation that although the assessing officer seems to be logically correct, but there is no mechanism, there is no section currently in the Income Tax Act. Your act, Income Tax Act, has not been able to visualize these type of indirect transactions and bring them to tax. So Supreme Court का ये observation था, and Government of India brought this amendment with retrospective effect so that it could then tax Vodafone. Now this backfired very badly, so much so that after a decade we had to actually take steps, because then what happens is this creates a very bad image at the international level. All the foreign companies will now be thinking, should we actually come to India and do business? Because we might analyze your taxation laws currently existing, and on that basis we will set up our business in your country. And what if 5 years down the line, 10 years down the line, you bring about an amendment with retrospective effect 20 years ago, with retrospective effect from the time Income Tax Act began, just so that we could tax this transaction and recover money from Vodafone for being a defaulting assessee. The Government of India at that point of time made this mistake of introducing the amendments but with retrospective effect. Had they introduced the amendment with prospective effect, things would have been much easier. Brand value of the country was badly tarnished at the international level. Vodafone then went into international arbitration, and then at international arbitration things became things came to a standstill. Then what were the amendments? First of all, 3 sections were amended. 1, definition of capital asset was amended and an explanation was inserted. Definition of transfer was amended and an explanation was inserted. And section 9 was amended by introducing explanation number 4 and explanation number 5. Now see this. We'll read things. We'll read these 3 amendments that were introduced, and then you'll understand okay, what is correct, why is it necessary that these amendments were introduced. See, look at the drafting. We'll do section 9 amendment as a third one. First of all, I want you to focus on first of all I want you to focus on the definition of capital asset. Yesterday's lecture, remember? Property of any kind held by the assessee. That word property includes any rights in or in relation to an Indian company, including rights of management, rights of control, or any other right whatsoever. by selling CGP ka shares, HTIL has transferred to Vodafone the management right, the control right of that Indian company. Now Vodafone controls CGP, CGP controls that Indian company HEL. So any management change, any management decision, any business decision, any business control thing can be indirectly influenced by Vodafone, because Vodafone is indirectly owning this Indian company. So definition of capital asset, property of any kind, that property includes rights in relation to an Indian company. Those rights can be management rights, control rights, business decision making rights, any type of right. Second, amendment in the definition of transfer that was introduced. Now this is a bit complex one, please pay attention properly. Transfer includes disposing of or parting with an asset or any interest therein, any interest in the asset, or creating any interest in any asset in any manner whatsoever, directly or indirectly, by way of an agreement, whether that agreement is entered into in India or outside India, or if it is not by way of agreement but by any other mode. Notwithstanding, the meaning of the word, you will find this word coming up at multiple places in the Income Tax Act. Notwithstanding means overriding. Notwithstanding, overriding the fact that such transfer of rights has been characterized as being effected or dependent upon or flowing from the transfer of a share or shares of a company registered or incorporated outside India. See, if you understood the facts of Vodafone case, you would have observed that this paragraph is drafted specifically to target the Vodafone case only. Shares of a company registered outside India, we are talking about CGP ka shares. Disposing of or parting away with an asset. Asset obviously means I am talking about capital asset. And this capital asset, we saw the definition, includes rights in an Indian company, notwithstanding the fact, overriding the fact that it has been shown that because of transfer of a share outside India, the rights of this Indian company, because of transfer of shares of a foreign company, the rights of this Indian company are being transferred, and that will also be included in the definition of transfer. Transfer includes disposing of the rights, creating any right in favor of somebody else. Directly you do it, indirectly you do it via agreement, you don't do it via agreement, irrespective of the fact that you are showing it as transfer of a share of a foreign company, but Indian company ka rights depend on that shares of foreign company, and those Indian company ka rights are also being transferred when the share of this foreign company is being transferred. Transfer ka definition includes such a complex thing also. Capital asset ka definition includes rights of an Indian company also. That means charging section 45(1), if there is a transfer of a capital asset means rights of Indian company. Transfer directly or indirectly includes this transaction. So now capital gain is taxable. And then comes section 9 ka amendment. What did they do in section 9? They said, what is the heading of section 9? Incomes deemed to accrue or arise in India. Any income accruing or arising in India through the transfer of a capital asset situate in India. Now, what did they do? This was always there. This is not the amendment. This point was always there in section 9. Explanation 4. For the removal of doubts, it is hereby clarified that the word through, which word? This word, through, shall mean and include and shall be deemed to have always meant this, shall be deemed to have always meant. This indicates that you are introducing this explanation with retrospective effect. Shall be deemed to have always meant by means of, in consequence of, by reason of. So, sir, what does this mean? All income, read the starting, I am reading this part. All income accruing or arising whether directly or indirectly through the transfer of capital asset. Through will also include by means of, so you can also read it as by means of the transfer of capital asset, in consequence of the transfer of capital asset, by reason of the transfer of capital asset. Now you are aware of this one fact, okay, the word transfer, this transfer word has been amended and that explanation has been inserted. Capital asset explanation has been inserted, it includes rights of an Indian company. So now they focused on that one word through. Through the transfer, through means by way of, in consequence of, because of, by reason of, all these things are also covered. And explanation 5, this is important, I would like a student to pay attention to this. For the removal of doubts, it is clarified that an asset or a capital asset, which is any share or interest in a company or entity registered or incorporated outside India, this is my capital asset. This shall be deemed, this shall be deemed and shall always be deemed, again you see the same words, always be deemed, to have been situated in India. This capital asset that we are talking about is deemed to have been situated in India if, here comes the important part, the share or interest directly or indirectly derives its value substantially from the assets located in India. See, CGP का shares, I think if I write it here it might be better, CGP का shares are deemed to be situated in India if these shares derive their value substantially from assets which are located in India. So you understood what happened? CGP has investments made in assets, sorry, CGP has investments made in HEL. CGP owns shares of HEL. HEL has assets in India which are used for telecommunication business. Where is CGP? CGP is in Mauritius. So share of a company registered outside India, that's my capital asset. But if that share derives its value from the assets located in India, from the assets of HEL, indirectly or directly, then it will be deemed, assumed that although the company CGP is outside India, its shares are deemed to be situated in India. And deemed to be situated in India means it is chargeable to tax in India. In fact, if you observe something, transfer of a capital asset. See these wordings. What are these wordings? Situate in India. And this explanation 5 is basically explaining this term. Okay, it will be deemed to be situated in India if they derive their value substantially, directly or indirectly, from assets outside India. From assets in India. If they derive their value, then even though the share is located outside India, it is deemed to be situated in India. Now, what happened in a nutshell? Vodafone purchased shares of CGP from HTIL. Shares were sold outside India. Buyer and seller both were non-residents. Transaction happened outside India. So they were of the opinion that this transaction is not subject to Indian income tax. Assessing officer is saying that indirectly you are transferring the control of the Indian company HEL and its fixed assets, all its assets in India. So this transaction is taxable in India. Bombay High Court said, assessing officer, you are correct. Supreme Court said, assessing officer, you are wrong. Supreme Court gave the judgment in favor of Vodafone. Finance Act 2012 made all these amendments, but made all these amendments with retrospective effect. Then in 2021, we brought about an amendment. I won't get into that detailed discussion because in our international tax wala syllabus, we'll see this again in an in-depth manner. So I'll just tell you briefly what happened. You might be aware of this because this is something very recent. Explanation number 5. We just read explanation 5, which said that even if the share is located outside India, it will be deemed to be situated in India if it derives its value substantially from assets in India. This is what explanation 5 says. The amendment that we introduced was, we introduced a proviso in the year 2021, and we said if the transfer has happened before 28th of May 2012. 20th May 2012 was when Finance Act 2012 came into force and all these amendments became applicable and the controversy began. The proviso is saying that if the transfer of this share outside India, but it derives value from assets in India, if the share has been transferred before this date, then explanation number 5 will not apply. If you think about it, it means what this government has done is, 2012 mein there was the previous government. What this government has done is, by introducing this proviso, they have removed the retrospective concept. If the transfer happens after 28th May 2012, so if you are transferring shares of a company located outside India, but those shares derive their value from assets in India, and if this transfer takes place after 20th May, say it happens today 2022 or it happened in 2018, 2019, then to explanation 5 will apply. Then we will ask you to pay tax. For all transactions which have happened before 20th May 2012, this explanation 5 will not apply. So we will not consider it as deemed to accrue in India. We will not consider it as taxable in India. That means then they went ahead. Then this 2021 wala jo amendment hai, it also mentioned two more things. Okay, by number 1, no case will be reopened. No reopening, reassessment will be done. No rectification order will be passed. No assessee will be treated as a defaulting assessee. If the transaction of transfer has taken place before this 28th May 2012, today our income tax officers will not invoke explanation number 5 and ask you to pay tax. No reopening. Second thing that it said, suppose already reopening has been done. already reopened. You have already used the Income Tax Act and done the assessment by reopening the case, or you have passed a rectification order and increased your tax, or you have treated the assessee in default, already done, then subject to conditions, we will consider, it will be deemed that this event never took place. Subject to conditions. Conditions are very simple. You see, if our income tax authority has reopened the case, or has passed a rectification order, or has considered you as an assessee in default and already told you to pay tax, number one, we will refund the tax back to you, but we will not pay any interest on that refund. Number two, you will, if you have filed an appeal, against that reopening order, then you will withdraw the appeal. As an assessee, you will withdraw that appeal. At the international level, if you have filed for any arbitration proceedings, you will withdraw the arbitration proceedings, and you will submit an undertaking in writing that you are waiving off your right of appeal, you are waiving off your right of arbitration, etc. We will refund back the tax that we have paid to you. We will not give you any interest on that income tax refund, and at the same time you also give us in writing that you will not file any further appeal, you will not go for any further arbitration. Whatever current appeals and arbitrations are pending, you will withdraw them. So this is the recent change that has happened. Okay, yes, explanation 5 has not been deleted, but explanation 5 says, okay, by if the transfer took place before 28th May 2012, then via this proviso, explanation 5 will not apply. Any new case, any new assessee will not be troubled by reopening, by passing a rectification order. And for those assessees who have already suffered, we will give you back income tax refund. We'll give you back the refund without interest, but subject to conditions that you also have to withdraw all appeals and arbitration. In-depth study we will do once again in the chapter of international tax in our 30 marks discussion, where we will redo this. I just wanted to touch upon the definition of capital asset and transfer, those paragraphs that I had missed, that I had not done with you. Chalo. Now going ahead in the chapter, see what did we do so far. If you really think about it, all that I have done is I have played with section 45.1. I divided 45.1 into basically 3 parts. Definition of capital asset. Along with that, we saw definition of long-term capital asset and short-term capital asset. Definition of transfer and computation under section 48, and along with 48 there are 7 provisos. We have discussed only 6 provisos, proviso number 1 to proviso number 5, and the 7th one we have discussed 6 of them. The 6th proviso is pending, but this is an analysis of 45.1 only. Now what next do you have to study? See, whenever there will be a capital gain transaction, a transaction happens, and via this transaction capital gain is taxable. Sorry, a transaction happens, capital gain is taxable, which means this is considered as a transfer, and if it is considered as a transfer, capital gain is taxable. So I will have to take the full value of consideration, subtract the transfer expenses, subtract cost of acquisition, cost of improvement. I'll have to do all of that. But then there are certain transactions which are not regarded, not considered as a transfer. They are not considered only as a transfer. Sir, why? Does it not fit up in the definition of transfer? Now, if you observe the transaction, you will see that the capital asset is changing hands. The capital asset is going from one person to another, or earlier it was one type of capital asset, now it has become the second type of capital asset. So there is something happening, there is a transaction happening. but Income Tax Act is not considering them as a transfer. Section number 46 and section number 47 gives you a list. Now what is the implication, beta? If they are not a transfer only in the eyes of Income Tax Act, that means section 45(1) charging section of capital gain does not apply only. That means section 48 also does not apply. I don't have to compute only. Capital gain is not taxable only. What is the point of calculating the capital gain? Whether the answer is 75,000 or 5 lakhs, the amount is not subject to tax. That means now what did the lawmakers do? After they defined or after they created the charging section 45(1), they said, okay, let us list down some transactions which will not be considered as a transfer, and all other transactions which are considered as a transfer, capital gains will be taxable. And for each and every variable in the formula, we will create sections and we will tell the assessee, this is how you will take full value of consideration. For taking this full value of consideration, follow this section. This is your transfer expense, follow this section. Cost of acquisition, follow all these sections. Cost of improvement, follow all these sections. Sections are created. So as a student, your study gets divided into two parts. You must be aware about all those transactions which are not considered only as a transfer. If they are not considered as a transfer, and if they come up in the question, all that you have to write down is, bhai, this is not considered as a transfer, capital gain is not taxable. If your transaction does not fall in the first part, then it falls here. So it is a transfer, so capital gain is taxable. Now find out the taxable amount, and in that process, if those sections apply, then go for those sections and calculate it using those sections. So now we are going to divide our discussion into these two parts. First of all, we will be focusing on all those transactions which are not regarded as transfer. We will be first studying section number 46 and 47. Just give me a second. Section 46 and section 47. Transactions not regarded as transfer. Now, one thing that I would want a student to remember when we are discussing this, if they are not regarded as a transfer, you know capital gain is not taxable. Sure, that means from this transaction, if you earn a profit, that profit is not taxable, fair enough. But the reverse also holds true, that if you suffer a loss, now this loss is not entitled to be set off and carry forward. Logical, na yaar? If the government is not collecting tax on the profit, it will not allow you the benefit of the set off and carry forward of the loss also. So by doing the transaction, if you suffer the profit, profit exempt. If you suffered a loss, ignore the loss. First point to study, section 46(1) and 46(2). Slightly important because there are many aspects to understand here. So please pay attention. What is a transaction? It says that when a company is distributing capital assets to its shareholders, and this capital asset is distributed by the company to the shareholder on liquidation, then for the company, this transaction is not regarded as a transfer. So if a company gives a capital asset to the shareholder on liquidation, you will not calculate the profit taxable for the company. Logical. What is a company doing? Basically, company after liquidation is paying off its liabilities. After liquidation, though, even shareholder is a liability, na? He is paid at the end after all our statutory liabilities and all outside liabilities are paid. But yes, at the end of the day, when liquidation happens, shareholder is also a liability for the company. And what the company is doing is distributing, giving away its own capital asset to the shareholder. So company ke liye we will not be making any capital gain taxable. 46(1) tells you that. Because 46(2) tells you that shareholder, you are the person who is going to pay tax on this transaction. 46(2) is saying that shareholder, this will be treated in your hands as relinquishment of the shares. Think about it. It's kind of very logical. If you are the shareholder and the company has gone into liquidation, as a shareholder, you have no choice. You have no choice but to hold on to these shares. Nobody is going to buy these shares from you. So sale is not possible. You cannot exchange these shares with anything else. You cannot convert these shares into stock in trade. Any other method of transfer is not possible only. The only method of transfer that is possible is you will surrender the shares back to the company and wait for your turn when you'll get the final settlement amount. So what you are doing is surrendering the shares back to the company. You are doing relinquishment of shares. And 46(2) is saying, okay, shareholder, this relinquishment of shares is considered as a transfer, and this relinquishment of share is considered as a transfer for you, and that means for you capital gain will be taxable. So we are collecting tax from the shareholder in this transaction. Therefore, company, you will not pay tax. Company, capital gain exempt for you. Shareholder, you are going to pay tax. Now, this is where I would want to discuss something in detail with you, because there are many things that I want you to pay attention to. Say there is a company XYZ Private Limited. This is a company at the time of liquidation. This is getting liquidated. Share capital, say 7 crores. It has 70 lakh shares of rupees 10 each. Let us say the company has reserves also at the time of liquidation. Reserves worth, let's presume, 10 crores. Now there is one Mr. Gopal. This Mr. Gopal, he purchased say 1 lakh shares of this company for rupees 12 lakhs on 19th of February 2016. He purchased 1 lakh shares for 12 lakh rupees. Now this company goes into liquidation. Liquidation happened on 29th of January 2022. But Mr. Gopal got full and final settlement. He got money, and let's say for instance he got jewelry from the company. Company gave him a check and company gave him a jewelry. If it is in kind, but obviously I will have to take the fair market value. Now he is getting jewelry worth, let's say, 34 lakhs and is getting money worth 20 lakhs. And So in totality 54 lakhs is what he's getting, and this is the full and final settlement, but he is getting this full and final settlement on 3rd of August 2022. Now keep this data in front of you and think about this. Question number 1. Gopal purchased the shares on 19th Feb 2016. Yeah, sorry for that. Okay, just give me a minute. Okay, I'll state the facts once again. XYZ Private Limited, a company, share capital 70 lakh shares of 10 rupees each, so that is 7 crore ka share capital, reserves of 10 crores. Mr. Gopal purchased 1 lakh shares for 12 lakh rupees on 19th of February 2016, and then the company went into liquidation. XYZ Private Limited went into liquidation 29th of January 2022. Mr. Gopal had purchased the shares 19th of February 2016, but liquidation process takes time, so he got his final settlement on 3rd of August 2022. Now the question comes up, first, is any capital gain taxable for XYZ Private Limited? No. For XYZ Private Limited, Section 46(1) applies, and according to Section 46(1), capital gain is fully exempted. So when XYZ Private Limited is distributing assets to its shareholders on liquidation, XYZ Private Limited is not going to pay any tax. Second, for Gopal, will things be taxable? So yes, for Gopal Section 46(2) will apply and things will be taxable. So capital gain has to be taxed, and first step is to decide whether it's going to be short term or long term. So here comes my first question. Holding period starts from the date of acquisition and ends on the date 1 day prior to the date of transfer. I held the asset up to the date of transfer. Now what is the date of transfer? Is it 3rd August or is it 29th January? What is the date of transfer in case of Mr. Gopal? So what is Mr. Gopal doing? Mr. Gopal is doing relinquishment of shares. When did he relinquish the shares? He relinquished the shares when the company went into liquidation. After 29th of January 2022. After 29 January 2022, the shares have absolutely no value only. So the period after the date of liquidation does not have any value. See this. You remember yesterday we saw definition of short term and long term. In that definition, shares held in a company in liquidation, holding period, the period subsequent to the date on which the company goes into liquidation shall be excluded. That means, coming back, what is the holding period of Mr. Gopal? Holding period of Mr. Gopal starts from 19th February 2016 and goes on up to 1 day prior to the date of transfer, that is 28th of January 2022. Point number 1. Point number 2. Can you make capital gains taxable for Gopal on 29th January 2022? That is the date of liquidation. That is the date of relinquishment of shares. That is the date of transfer. As per charging section 45(1), capital gain is deemed to be income of the year of transfer. But then ask yourself practically, on 29th January 2022, does Gopal know that he is going to get money of 20 lakhs and jewelry of 34 lakhs totaling up to 54? On the date of liquidation, does Gopal know how much is he going to get for the shares? Answer is no. Array, in fact, on the date of liquidation, Gopal does not know whether he'll get something or not. How much he'll get is a secondary question. After paying off all others, will anything be left for the shareholders or not? That is also a question mark. So you can't make a capital gain taxable by using our default year wala concept. We will have to make a capital gain taxable when? On 3rd of August. 3rd of August is the date when Gopal comes to know, okay, this is my full and final settlement amount that I am getting for relinquishing my shares. Now I have deliberately kept the two financial years different so that you understand the concept. 29th January 2022 is previous year 21-22 and this falls in previous year 22-23. So what is the concept that we learn from this? Okay, by capital gain is not taxable in the previous year of transfer, that is the previous year of liquidation, because in that year I don't know whether I will get anything or not. Capital gain will be taxable in the previous year when the final settlement is received. Third, looking at the dates, you can easily come to a conclusion that this is a long-term capital asset. So once you say it is a long-term capital asset, what about indexation? But sir, yesterday we studied that for equity shares which are covered by section 112A, indexation does not apply only. Remember, 112A is only talking about listed equity shares which are sold through a recognized stock exchange in India. Now if you pay attention to my example, number one, I have taken the example of a private company. Number two, this is not a transaction of sale, this is a transaction of relinquishment of shares. So in either case, for this shareholder, when you are talking about relinquishment, section 112A is not applicable only. Section 112A talks about selling them through the stock exchange, whereas when it comes to liquidation, transaction is going to be off market, transaction is not going to be done in the stock exchange. So 112A section is not applicable only. When 112A applies, you don't get the benefit of indexation, but your 112A does not apply, so indexation benefit will be available. So coming back to our question, will you do indexation up to the year in which the settlement amount is received or up to the year of liquidation? So common sense, indexation is done up to the year of transfer. When did the transfer happen in my example? Transfer happened January 2022 May. That means indexation will be from the year 15-16 to the year 21-22. Just to put it in perspective, capital gain is not taxable in 21-22. Capital gain is taxable in 22-23. But we are not going to do indexation up to 22-23. We are going to do indexation only up to the year of transfer, that is a year of liquidation. Chalo, comes the next thing. Okay, let's compute the capital gains. Computation. So for computation purposes, what will the shareholder say? I got money worth 20 lakhs. What was it? 20? Yeah, 20 lakhs ka money and 34 ka jewelry. Jewelry whose fair market value is 34 lakhs. In effect, I got 54 lakhs. Now, I think the previous slide will help you to understand my next point. Look at the data, please. He has purchased these shares at a cost of 12 lakhs and he is getting full and final settlement amount of 54 lakhs. So, keeping indexation discussion aside for a minute, 54 minus 12, sir, 42 lakhs is capital gains. He purchased these shares for 12 lakhs. Now when he is surrendering it, he is getting 54. So 54 minus 12 is his capital gains. Wrong. Become Mr. Gopal yourself and think. At the time when this company is liquidated, are you happy just getting back your share money out of that 7 crores? ये 7 crore का जो share capital है, is it only that you want? नहीं. As a shareholder, you also want something from these reserves ना? ये जो 10 crore का reserves है, you should get something out of that reserves also. 10 crore का reserves, you should get something. That means when you are getting that full and final settlement of 54 lakhs, it includes your share of reserves and it also includes your share capital that you are getting back. So you cannot say 54 lakhs is fully capital gains, because ask yourself, for relinquishing the shares you are getting something, your proportion of reserves and surplus you are getting something, and this total is 54. Now when reserves are paid by company to shareholder, what is it? When the company gives its reserves, when the company pays its reserves to the shareholders, what is it? That is called as dividend, and dividend is taxable as income from other sources, not capital gains. Just for convenience, let me change this amount so that our calculation becomes very easy. 14 crores. I'm just taking round figures, convenient numbers. 14 crore का reserves है. Mr. Gopal has 1 lakh shares out of total 70 lakhs. He should get something out of the reserves also. So when we are doing this 54 lakhs का calculation, this 54 lakh का calculation includes some proportion of reserves, and that proportion of reserves will be taxable as dividend. Section number 22 section number 2 clause number 22 subclause number C defines this situation, that when a company on the occasion of liquidation distributes its accumulated profits, reserves and surplus, it will be treated as dividend. 1 lakh shares out of 70 lakh shares and 140 lakhs, 14 crores. So how much is he supposed to get? 2 lakh rupees, if my calculations are correct. This 2 lakh is not exempt for him. This 2 lakhs is taxable for this Mr. Gopal as income from other sources. It is taxable for him, and that means now after adjusting, eliminating these reserves, whatever he now gets balance, this is his full value of consideration. From this we will subtract index cost of acquisition. He has purchased the shares at a cost of 12 lakhs. Indexation will have to be done, and we have concluded that indexation is to be done from 1516 to 2122. So if I can find the table of index numbers, yeah, 1516, 2122, 254 and 317. So 317 divided by 254, this will give me some indexed cost of acquisition, I'll take that index cost of acquisition, subtract it, and what I now get, this is my taxable long-term capital gain. Points to understand: in computation, whatever I get as my full value of consideration has two parts: proportion of reserves, accumulated profits, and the balance is for surrendering the share. This 52 lakhs is the consideration that I am getting for relinquishing the shares. Remember, 52, not 54. 2 lakhs is taxed as IFOS. 52 is considered for capital gain purposes. And then we'll do indexation, we'll subtract the cost, balance amount, long-term capital gain, taxable. This is taxable for previous year 22-23, assessment year 23-24. Whatever this amount works out to. I'll work it out later on when I give you the soft copy of the handwritten notes. As of now, I'm not wasting our classroom time for it. I'll do the multiplication and I'll write the answer. Fine. You can also do it on your own. Last point to learn here. From this example only, you can easily tell me. See, could you understand one thing? Company gave jewelry, which means company gave something in kind to the shareholder. Now, Mr. Gopal got jewelry worth 34 lakhs. What is 34 lakhs, beta? 34 lakhs is the fair market value of that jewelry. And we took 34 lakhs into consideration. We took 34 lakhs into account. We took 34 lakhs in our calculation. Some of it is taxed as IFOS, some of it is taxed as capital gains. But now who has the jewelry? Now who has the jewelry? Gopal has the jewelry. In future, in future, when Gopal will sell this jewelry, what will you take as cost? Let's say, for example, this jewelry is sold for 40 lakhs. Should you make future, say 6 months down the line, 1 year down the line, 5 years down the line, Gopal has this jewelry and he sells this jewelry for 40 lakhs. Do you think it would be correct that you say 40 lakhs full value of consideration, fully taxable as capital gains? Wrong, hai na? 34 lakhs was considered for calculating the taxable income of Gopal, whether you call it as income under the head other sources, dividend, or income under the head capital gains. But 34 lakh, one way or the other, has become taxable. So now that 34 lakhs will be taken as cost of acquisition. This is mentioned in 55 subsection 2. I don't know if I've ever got the chance of mentioning this in my earlier lectures, but remember this rule for Income Tax Act, not just capital gains, Income Tax Act, Pura Income Tax Act. Remember this rule. Whatever you are calculating, capital gains, PGBP, salary, IFOS, whether you are calculating the income part or the expense part, the credit side or the debit side, market value, fair market value will be taken for calculation only if there is a section which allows you to take it. You cannot take fair market value just like that. In the calculation of income, whether it is income from salary, whether it is income from capital gains, PGBP, IFOS, for that matter, even for calculating deductions, when we do chapter 6A deductions, you will recollect this point of mine. When you are doing any computation under the Income Tax Act, market value will enter into your calculations. Market value will be part of your calculations only if there is a section which authorizes, which allows you to do so. 34 lakhs ka fair market value has to be considered. Where is it written? Section number 46 subsection 2, which makes things taxable for Gopal, writes down this concept. That fair market value subsequently will become your cost. 34 lakhs ka FMV will become your cost. Where is it written? Section 55 2 mein it is written. So there should be a section. Apni marzi se you cannot take FMV. on your own you cannot take FMV into calculation. Section में लिखा है only then and only then you are allowed to take the fair market value for calculation. चलो, first point done. Transactions not regarded as transfer. 46.1 company not regarded as transfer. Shareholder 46.2 it will be treated as relinquishment of shares and you will have to pay the tax. For you this will be treated as taxable. Taxable under two parts. Whatever is your share of reserves that will be covered under the head of IFOS dividend. Balance will be considered for relinquishment of shares and you will calculate your taxable capital gain. Chalo, going ahead. Second point. Now I am picking up small points for discussion. This is where now I start with section number 47. Section 47 has various clause numbers. 47 is a list. So list है मतलब clause numbers है. There is no subsection, clause number. If you can try and remember them, otherwise don't break your head. There are some clause numbers which I will specifically tell you कि please definitely please remember this. Whenever they come up, please do remember it. The others you can just remember section 47. Like the first one, section 47 clause number 1. Okay, if you want to, if you can remember, great. Otherwise it's okay. If you can't even remember, just section 47 is sufficient. When there is a HUF and the HUF is distributing capital assets on its partition. So obviously the person who is going to receive is a member of this HUF. Then 47.1 is saying that HUF for you this transaction is not regarded as transfer. One way if you understand, this is similar to company shareholder. Company was paying off its liabilities. HUF on partition is paying off its liabilities towards the members. HUF will not pay tax. But please don't take my statement blindly. Sir, you said in a way this is similar to company shareholder. That means in that transaction of company to shareholder, shareholder paid tax. In this transaction of HUF to member, will member pay tax? See, when it was company to shareholder, the event was liquidation. Here the event is partition. So company not taxable, shareholder taxable. HUF not taxable. Will capital gain be taxable for the member? Answer is no. Capital gain is not taxable for the member of HUF also. Shareholder, yes. Member, no. Sir, why? Something very smart. Pay attention. Way back in the year 1981, Supreme Court gave a judgment on a different case altogether, not on this situation. Nah, it was a different case altogether. But in that case, the rule that was established, the principle that was established, that is applicable here. Supreme Court gave a very fantastic judgment. Supreme Court said, in the computation process, if any variable cannot be ascertained, cannot be determined, cannot be expressed in numbers, then the computation mechanism fails and capital gain is not taxable. Too technical? Let me simplify it. Supreme Court says something very simple. Dekho, step 1, you say it is taxable. Step 2, compute the taxable amount. Now step 2 and step 1 are connected to each other, na? Computation of taxable amount. So is it taxable? Yes. Okay, chalo compute karo. Now they are together. They are one and the same thing. They are part of the same concept. If you claim that capital gain is taxable, as Income Tax Act, you have to provide for the taxability calculation also. If you cannot calculate the capital gains, then the whole mechanism fails. What is the point? Ask yourself, common sense. What is the point of saying it is taxable, but how to find the taxable amount? I don't know. Matlab, Income Tax Department is saying कि नहीं, Ronak, this is taxable, but कितना taxable? Ronak वो calculate नहीं कर सकते. Then it is not taxable ना, because you can't ask the assessee कि pay this much tax. This was the Supreme Court judgment which gave this principle. Any variable, FVC, COA, COI, full value of consideration, cost of acquisition, cost of improvement, any variable in the formula, any variable in the computation process, if that cannot be ascertained, if that cannot be determined, if that cannot be expressed in numerical terms, in numbers, then the computation mechanism fails. This rule applies here. How do you become a member in HUF? You become a member in HUF by way of birth. You become a member in HUF if you get married to an individual who is a member of the HUF. So now you are the wife of that individual, and so you are also a member of this family, or by adoption. Now you cannot decide the cost of acquisition of becoming a member of HUF. How will you express the cost of becoming a member? Birth, adoption, marriage, you cannot express it in numeric terms, and you cannot say it is zero, You cannot say it is zero. When you are saying zero, it means you are able to calculate it. इधर तो calculation ही possible नहीं है. I don't know if you can think, but cost of bonus share is zero. There, bonus share is given to you free of cost. You are not paying anything. You are getting shares zero. That is capable of expressing in numeric terms. यहाँ पे it is something abstract. Somebody gets married into the HUF and becomes a member. What is the cost that you pay? You are born in the family and by birth automatically you are a member of HUF. What is the cost that you have incurred to get the HUF membership? You cannot express it in numeric terms. When you cannot express it only in numeric terms, how can you say कि member of HUF to tax भर? Shareholder का case is different, huh beta? When shareholder purchases shares of a company, he is entering into a contract with the company. So their cost of becoming a shareholder can be expressed in numeric terms. Cost of becoming a member cannot be expressed in numeric terms. So capital gain calculation fails. That means in this case, HUF will not pay tax when it distributes the capital asset, and member receiving the capital asset will not pay tax also. There is no concept of surrendering your membership. And even if there is a concept, cost cannot be ascertained, cost cannot be determined. So capital gain is not taxable for both. Chalo. Going ahead. Point 3. Important, you have studied this at CA intermediate also. So I am assuming that you will remember quite a lot of this point. If a capital asset is given by one person to another, is transferred by one person to another through will, through irrevocable trust, or through gift, then this transaction that has happened is not regarded as transfer. This is section 47.3. Important. If you can remember 47.3, wonderful. Otherwise, it's okay. 47 yaad rakho, that's more than enough. Acha. Now, what is this? See, I'll pick up each and every word and I'll try to simplify that. There's nothing great here. Any capital asset that is transferred through will. When does will apply? Will applies after the death of a person. So if Ronak dies and I give, let's say, the jewelry that I have to my wife, the shares of a certain company to my son, a property to my daughter, some debentures to my younger brother, I am transferring these assets, I am giving these assets to my wife, to my son, to my daughter, to my brother, but I am not doing it to earn profit, na? This transfer is automatically happening. This is an automatic transfer of capital asset. If I die today, these people will get the assets tomorrow. If I die 10 years later, then as per my will, they will get it 10 years later. If I die 25 years later, they will get the assets 25 years later. That means आज नहीं तो कल ये ट्रांसफर तो होने ही वाला था. This was not a transfer done to earn profit. It's an automatic transfer. So capital gain is not taxable. My assessing officer in my last return of income after my death, my last return तो will be filed ना. Up to the date of death, whatever income I have earned, उस पे टैक्स तो भरना पड़ेगा. In my last return of income, my assessing officer cannot do this calculation. कि रोनक, you gave jewelry to your wife, चलो उसका मार्केट वैल्यू लेते हैं, माइनस कॉस्ट, इतना टैक्सेबल. You gave shares to your son, market value minus cost of share, इतना टैक्सेबल for you. नहीं, it's an automatic transfer. Capital gain is not taxable. Transfer made through gift. What is the meaning of gift? Gift means no consideration. That means, simple example, Ronak transferred a capital asset through gift. And समझो I gifted a capital asset to my friend Nihal. Now common sense use करो. Ronak gifted a capital asset to Nihal, which means how much did Nihal pay? Who is Nihal? Nihal is my friend. Ronak gifted a capital asset to Nihal. So how much did Nihal pay? The consideration that is paid, Nihal paid nothing. Let me create one more example. कि Ronak also gifted a capital asset to one Mr. Keyur. Now who is Keyur? Keyur is Ronak's brother, relative. So to make things a bit convenient for you, I'll say Ronak is the giver. Nihal and Keyur, they are the receivers of this gift. They are receiving a capital asset. Now, if you remember your CA intermediate, your mind will start thinking multiple sections simultaneously. There are 3 persons in my example. Na? Let's talk from each and every person's perspective. Ronak is the giver. Ronak gifted one capital asset to Nihal and other capital asset to Keyur. Same question I'll ask you. How much did Keyur give to you? How much did Keyur give to Ronak? In this case also, the consideration is 0. So Income Tax Act is exactly saying this only. Ke Ronak, for you, capital gain is not taxable in both the transactions. In both these transactions, capital gain is not taxable. Thoda common sense use karo. If you think about it, for taxability of capital gains, you need the first thing as FVC. What does FVC stand for? Full value of consideration. But consideration is not there only. 0 consideration. That means, please think very carefully. Can my income tax officer, can my assessing officer do something like this? Ke Ronak, you didn't get any consideration na. Let us take fair market value, subtract the cost and say this capital gain is taxable for you. Can this be done? Answer is absolutely wrong. Nah, you cannot do it. According to Income Tax Act, this gift wala thing is a transaction not regarded as transfer. तो जब ट्रांसफर ही नहीं है तो कंप्यूट क्यों करना है? At the same time, please also understand कि Ronak also cannot make this argument कि when I gifted the asset, FVC that I got is 0 consideration. तो एक काम करो, cost minus करो, and this is the capital loss that I have suffered. Allow this capital loss to be set off and carry forward. क्या ये चलेगा? ये भी नहीं चलेगा. This is also absolutely wrong. This transaction is not regarded only as a transfer for the one who is making the gift, who is giving the gift. So for Ronak, nothing is taxable. Now just an extra point. You guys might have thought, sir, in this case, Nihal is a friend and as the receiver, for him, income from other sources will apply. Answer is yes, it will apply. Section 56, subsection 2, clause number 10. For Nihal as a friend, income from other sources will be taxable. But if you remember your CA Inter, you will also remember, okay, sir, in this case for Keyur, who is a brother, who is a relative is given exemption in 56 to 10. So IFOS ka 56 to 10 is not taxable. Please look at this example and understand what I am saying. Who is Nihal? Nihal is the receiver of gift. Who is Keyur? Keyur is also the receiver of the gift. They are receiving the capital asset as a gift. For them, the appropriate head of income is IFOS. My focus is not on Nihal and Keyur. My focus is on Ronak. As far as Ronak is concerned, Ronak has transferred a capital asset through gift. So legally it is not being considered or regarded as a transfer. And if it is not regarded as a transfer, for Ronak, capital gain is not taxable. What are the implications for Nihal and Keyur? When we do IFOS, we'll see them. But as of now, Ronak is not going to pay any tax. So, will wala point done, gift wala point done. Now that I, what does that I stand for? I stands for irrevocable trust. Okay, what is the meaning of this? The word trust means that trust is the transferee, and the word irrevocable means non-cancelable. Nothing great. I'll just spend 2 minutes on this and just wrap it up very quickly. Say for example, I take myself as the transferor. I give a capital asset to a trust, and this transaction is an irrevocable transfer. Sir, what does this mean? Ronak cannot revoke. Irrevocable. The word revocable means we are talking about revoke. So, revoking, cancelling the event, revoking the transaction is not possible. I give a capital asset to the trust. What is the trust going to do? Trust is going to use that capital asset and generate income, and use that income for the purpose for which the trust is created. And that purpose can be any purpose. It could be a charitable purpose, it could be a religious purpose, it could be a private purpose, private type of a trust, benefiting only a certain set of people, predefined set of people. I don't care why the trust is created. I am not concerned about the fact that the trust is a public trust or a private trust. What I am talking about is the fact that there is a trust. Trust is created for a purpose. अब वो purpose achieve करने के लिए it needs income. Income किधर से आएगा? Income आएगा from assets. तो Ronak gave the asset, and Ronak said, till the trust remains, till Ronak is alive, this asset will not be taken back. It is irrevocable, non-cancelable. I will not take back the asset from the trust. Now, who is the transferee? Trust. Is it irrevocable? Yes. And so Income Tax Act बोलता है कि in this case Ronak, this will not be regarded as a transfer for you. It means on this, capital gain will not be taxable. Nobody will calculate any notional capital gain. Trust is not paying anything. Trust is not paying anything. Obviously, if trust had money to pay the capital asset, then this transaction would not have happened only. Trust would have used its own money only for that purpose. So I am giving the asset free of cost. I am not charging anything. But I am saying that the asset will remain with you for X number of years, till Ronak ka lifetime, till trust ka lifetime. You can define it the way you want. It is irrevocable. So irrevocable hai, and trust is the transferee, तो capital gain is not taxable. What did I just say? Irrevocable है and trust is the transferee, तो capital gain is not taxable. That means, example 1, if it is revocable and the trust is the transferee, I give the asset to the trust, but in future, anytime, tomorrow, 1 month later, 5 years later, anytime in future, I can write a letter, I can send an email and I can get back the asset. Then it is a cancelable, revocable type of a transaction. I can cancel it any point of time and take the asset back. Now, no exemption, capital gain becomes taxable. If I am giving the asset in an irrevocable way, but the transferee is not a trust. I give the asset to my friend, I give the asset to a partnership firm, I give the asset to a HUF, I give the asset to one of my individual relatives. Trust नहीं है, irrevocable है, but the transferee is not a trust, is somebody else. Then also capital gain will become taxable. If you want the exemption of capital gain, you got to ensure कि भाई it should be irrevocable and the trust should be the transferee. Now, what did we study? Transfer of any capital asset through will, irrevocable trust or gift is not regarded as a transfer, is a transaction not considered as a transfer. 47.3. In this 47.3, government introduced, in this 47.3, government has introduced a proviso to section number 47.3. Now, use the meaning of the word. What is the meaning of the word proviso? Proviso means I am talking about an exception. What does 47.3 say? 47.3 says that it is a transaction which is not regarded as a transfer, not considered as a transfer. And now if you are creating an exception to it, it means this transaction is considered, is regarded as a transfer. What is the exception? Shares allotted through the ESOP scheme, if they are transferred through irrevocable trust or gift, then that is a proviso. Then it will be considered as a transfer. Pay attention to the word ESOP. When ESOP comes into the picture, the two persons coming into the picture are employer and employee. When employer allotted the ESOP to the employee, under Income Tax Act, this is treated as a perquisite. Section number 17(2), subclause number 6, and it's a perquisite, which means it is taxable under the head salaries. So this is salaries का event. Now who has the shares? ESOP. ESOP shares किसके पास है? Employee के पास. What the Income Tax Act is trying to say is कि if these shares are gifted to anybody, relative, non-relative, I don't care, any person. If employee is gifting the ESOP to any person, now employee, for you 47(3) का जो capital gain exemption है, ये नहीं मिलेगा. This will not be available to you. Logic is very simple. ESOP का E मतलब employee. So these shares are meant for the employee. Employer gave it to employee free of cost or at concessional price, depending on the ESOP scheme. But they are meant for employee. It's because you are the employee that you got these ESOP shares. Now, if you got these ESOP shares and you are passing on the benefit to somebody else by gifting this ESOP, that is not permitted. As in, can you gift? हाँ, तुम गिफ्ट कर सकते हो, but if you gift it, this exemption will not be available to you. ESOP का gift will be treated as a taxable transfer. To make this clear, more clear in your minds, I would want you to imagine one simple thing. Imagine करो कि you are the employee from the stock market, you are buying shares of XYZ company, any company. You are an employee of, say for example, Reliance, but you are buying shares of Tata, Bajaj, IDFC, HDFC. You are buying any shares. Those normal shares that you are buying, ESOP share nahi, normal share, you are paying the full price and buying it. Now you gift those shares, capital gain exempt. ये share ESOP वाला है. Reliance, your employer has given those ESOP shares to you. They are meant for employee. If you gift that, तो capital gain exempt नहीं, तो capital gain taxable होगा. तो capital gain taxable होगा. Now comes our challenge. अच्छा भाई, गिफ्ट हुआ टैक्सेबल, तो फुल वैल्यू ऑफ कंसिडरेशन माइनस कॉस्ट ऑफ एक्विजिशन. कॉस्ट ऑफ एक्विजिशन आई विल डिस्कस विथ यू लेटर. आई एम डेलिबरेटली कीपिंग दिस पेंडिंग लेटर. बट प्रॉब्लम इज दिस गिफ्ट टैक्सेबल? आंसर इज यस. अब इफ दिस गिफ्ट इज टैक्सेबल, तो हाउ मच कंसिडरेशन हैज दैट person paid? Nothing. This is where that one proviso that I have kept pending is what I am currently doing. Sixth proviso to section number 48. Yesterday's lecture, computation का section 48. First to fifth we did and then we went to seventh. Sixth बाकी था. Because of this, whatever is the fair market value of the share on the date of gift, this is taken as full value of consideration. ये देखो, these are our provisos. Sixth proviso, where shares, debentures, warrants referred to in the proviso to 47.3. 47.3 says capital gain is not taxable, but in that there is a proviso which says कि भाई when this ESOP वाला shares are gifted, capital gain is taxable. Provided also that where shares, debentures or warrants referred to in this proviso are transferred under a gift or an irrevocable trust, the market value, half an hour ago I told you this, you can see this coming up once again. You cannot take fair market value on your own. अपनी मर्जी से calculation में नहीं ले सकते. There must be a section which allows you to do so. Here comes another example. Section 48 के 6th proviso में लिखा है कि you can take the market value. The market value on the date of such transfer shall be deemed to be the FVC, full value of consideration, for computing capital gains. Capital gain compute करना है when your situation falls in 47.3 नहीं, उसका proviso. So what is 47.3 का proviso? देखो, this is 47.3. मेन प्रोविजन सेस गिफ्ट, विल, इररेवोकेबल ट्रस्ट. उसका प्रोवाइजो क्या बोलता है? प्रोवाइडेड दैट दिस क्लॉज शैल नॉट अप्लाई. 47.3 शैल नॉट अप्लाई. एग्जेम्पशन अंडर 47.3 shall not apply to transfer under gift or an irrevocable trust of a capital asset which is shares, debentures or warrants allotted by a company directly or indirectly under employee stock option plan or employee stock option scheme. So as an employee you will not get the benefit of the exemption if shares are, and I would like to highlight, gifted or transferred through irrevocable trust. So exemption will not be available. Ab exemption is not available. Okay, that means capital gain is taxable. So capital gain is taxable. How do I get full value of consideration? Look at the sixth proviso to section number 48, which helps you to take the fair market value. Last point here to observe a very small thing, but I would want you to observe this properly. Guys, read it. The proviso, I think some of you might have already observed it also. The proviso covers I, irrevocable trust. The proviso covers G, gift. But this proviso does not cover the transaction of will. Transfer through will is not covered by the proviso. What is the will wala concept? See this. What did I write? Sorry. If capital asset is transferred through will, it is not regarded as a transfer. What was the logic that we studied? It is an automatic transfer that is happening on the death of a person. So yaar, whether it is normal shares of a company, property, jewelry और ESOP वाला shares, will के through जो transfer होगा वो तो exempt ही होगा ना. Capital asset transferred through will, even if that capital asset is ESOP, it is still an automatic transfer. That means capital gain will still remain exempt in case of will. That is why the lawmakers, when they have created the proviso, they have only talked about irrevocable trust and gift. These are the two things which you do on your own. Automatic nahi hota. You transfer it to a trust voluntarily. You gift it to someone voluntarily. So will is not covered only in that proviso, is not covered only in that exception. It means if I have to just put it in a concise way, I could probably say this. Okay, suppose I am talking about a capital asset which is, let's say, ESOP securities. Now if these ESOP securities are transferred through will, irrevocable trust or gift, or समझो any other method like sale, relinquishment, exchange, तो if they are transferred through will, not taxable. If they are transferred through gift, irrevocable trust, taxable. And any other method तो obviously will be taxable. Sell कर दिया ESOP securities, given it in exchange, converted into stock in trade, relinquishment, तो वो तो सब obviously taxable है. Now if I say okay, my capital asset is any other capital asset other than ESOP, and I have the same bifurcations through will, through irrevocable trust, gift, and through other methods. तो will हुआ तो not taxable, irrevocable trust या gift हुआ तो भी not taxable other than ESOP. And if it is any other method which is formally included in the definition of transfer, sale, exchange, relinquishment, etc., etc., तो by capital gain obviously is going to be taxable. This is something very logical कि भाई हाँ ये तो taxable होगा. This is not taxable under section 47(3). This is not taxable under 47(3). This one is also falling under 47(3), and this taxability is as per the proviso to section 47(3). This brings us to the end of this ESOP, this discussion. WIG, will, irrevocable trust and gift. Chalo, going ahead. Now I'm doing up some very small things, some concepts which are again kind of CA inter concepts, very simple. They are there in section 47, so we will have to just mention it. Like for example, when debentures get converted into shares, so you are the owner of these debentures and these are convertible debentures, and these are either fully or partly converted into shares. So at that point of time when that conversion happens, you're not going to tell this debenture holder, okay, you gave up your debenture or you gave up a part of your debenture and in return you got shares, so you pay tax. No, that's not going to happen. Like if somebody wants to compute, you might be able to compute like this. Full value of consideration, you might say fair market value of the shares received minus cost of acquisition, you will say cost of the debenture that you have surrendered. If you have surrendered the debenture fully, to pura cost. If let's say only 70% has been converted into share, तो 70% cost. तो technically ये तुम्हारा profit है. This could be your profit or this could be your loss. So if anybody wants to do calculation, this is the way calculation is done. I had one debenture costed me say 160, it got converted into 4 shares. When it got converted into 4 share, the fair market value of each share was say 60 rupees. So now if for calculation purposes you want to do, you can do the profit calculation like this, कि you are getting 4 shares जिसका combined value is 240, for which you are surrendering a debenture worth 160, तो ये 80 rupees का profit हुआ. All said and done, it is this 80 rupees which is not taxable. This capital gain or capital loss is not taxable. Loss भी हो सकता है. For example, if I say that the market value of this share was 30 rupees, so 30 into 4, you got shares of 120 by surrendering a debenture of 160, so 120 minus 160, 40 rupees का loss हुआ. But then all of that loss will also be ignored. Conversion पे taxable नहीं होगा. If you think about it, one way of seeing it is कि ये तो notional है ना, money has not come into my bank account. I gave up debentures and I got shares. So this is one giving away one security, getting another security in return. There is no profit I have actually realized in my bank account. When these shares will be sold, so at that point of time I will earn actual profit. So at that stage it will become taxable. Okay, this was an example of, this example that I took was an example of fully convertible debenture. You can also take an example of partly convertible debenture. Okay, by just for the sake of it, if I write down, okay, by there is one debenture जिसका 70% is converted into share, and this debenture costed me 160 rupees. So now 160 ka 70% is what you are surrendering, that much debenture you are surrendering. 160 ka 70%, 112. And now if the fair market value of the share that you are getting in return, you are getting share na, if that is 120, you are having 8 rupees ka profit. If for example it is 110, you are having 2 rupees ka loss. But this profit or loss is not to be considered only. The only point worth discussing here would be something like this. Okay sir, fully or partly, full conversion or part conversion. Later on, subsequently, when I will sell my shares, at that time the capital gain will be taxable. Answer is yes. Then what is the cost of acquisition of that share? So very simple. Cost of acquisition of the share is the cost per debenture, if you think about it, multiplied by the percentage which is converted. So cost of the share will be, in my example 160 का debenture है, 160 का debenture got converted into 4 shares. Now that 4 shares का cost will be 160, 100%. Or to make it even more accurate, if you understand maths, cost per debenture divided by the number of shares that are allotted to you per debenture. This will be your cost of acquisition of the share. And what will be the cost of acquisition of the debenture? In case of a full conversion, fully convertible में तो debenture है ही नहीं, but partly convertible debenture में even after the conversion थोड़ा बहुत debenture is still pending ना, so that will be total cost minus the cost of the share that you have allocated. All of this is mentioned in section number 49(2)(a). मतलब section 47 is telling you that capital gain is not taxable on conversion, and later on 49 is explaining to you that when debentures got converted into share, the cost of that share will be whatever part of the debenture was converted into share, that cost of the debenture of that part of debenture will be cost of the share. Now going ahead, this was what, point number 4. Something similar, point number 5. If I have preference shares and those preference shares are converted into equity shares, then again here I can have the same concept, fully or partly converted into equity share. So at the time of this conversion, capital gain is not taxable. So what will be the cost of acquisition of that equity share? The cost of acquisition of the equity share will be cost of that preference share into whatever proportion of the preference share has been converted fully or partly. If by chance it is a case of part conversion, that means some portion of the preference share will still remain after the conversion also. So whatever is the original cost incurred minus the cost of equity share, that portion which has been converted, you minus it, balance is the cost of the preference share. This cost wala funda is given to you by section number 49(2)(f). Basically it is saying the same thing na yaar. I think 2F या 2AF, एक सेकेंड, just 1 minute. Okay, 49(2)(a). I just got confused with the alphabet. 49(2)(a). Debenture getting converted into share, conversion pe nothing is taxable. Preference share getting converted into equity share, at that stage also nothing is taxable. Yesterday, if you remember, we did this one point, sovereign gold bonds. Yaad karo beta, what did we study regarding sovereign gold bonds? That you give money and at the prevailing gold rate, bonds will be allotted to you. In case of those bonds, you will get some interest income also, and later on when redemption happens, at the time of that redemption, whatever is the prevailing gold rate, according to that you'll get money. So basically you are investing into bonds, but the bond amount is connected to the gold value. Now yesterday we saw to reduce imports, to preserve our foreign exchange reserves, this sovereign gold bond ka concept has been introduced. And what is the tax benefit given? By sovereign gold bonds, if my assessee, you might remember this, if my assessee is an individual and the method of transfer is redemption. So yesterday I said capital gain is not taxable, which is correct. The technical part is by this transaction is not regarded as a transfer. But remember, what is not regarded as a transfer is only redemption. So if there are other methods like sale, exchange, conversion into stock in trade, then they will be considered as a transfer, no doubt about it. And this exemption is available only if you are an individual. So if the assessee is not an individual, if the assessee is a HUF, a company, a partnership firm, and you want to take the benefit of this sovereign gold bonds, then you will not get any tax benefit out of it. Whether you go for the option of redemption or you go for the option of any other method, you will not get any section 47 ka benefit. In both cases, this is regarded, this is considered as a transfer. And if it is considered as a transfer, capital gain is taxable. Yesterday we also learned this extra thing कि हाँ भाई transfer है, capital gain is taxable. And if the sovereign gold bonds are long term capital assets, then although they are bond, they are equal to physical gold. In the eyes of Income Tax Act, they are treated at par. So despite the fact that they are bond, indexation benefit will still be allowed to you. This is the fourth proviso to section number 48. Chalo, now doing the last thing for today, and this is where I now start to discuss something difficult. What I am going to do now today and my session tomorrow, these are exclusively section 47 topics for CA final level. CA inter mein these topics are never taught to the students. They are only meant for CA final. So that's pretty obvious also. Okay, they are slightly on the difficult side when it comes to understanding, and therefore CA final pe they are discussed with the students, not at CA inter. The point that I am picking up is the concept of amalgamation. Amalgamation of the companies. So I am thinking about the event of amalgamation. Amalgamation has been defined in the Income Tax Act also in section 2. In our textbook chapter number 1, the definition of amalgamation has been printed. Once when you get time, just read it. There's nothing great. The concept of amalgamation is something really important. We are studying amalgamation right now in capital gains. We will study amalgamation in IFOS also. We will study amalgamation related concepts in PGBP discussion also. In the chapter of set off and carry forward of losses, there will be something connected to amalgamation that we will study. So these points related to amalgamation, they are quite important to understand. See, sorry, when I am talking about amalgamation, broadly speaking, I am talking about an amalgamating company on one hand and on the other hand I am talking about an amalgamated company. Just give me a second please. Sorry. So where does capital gain come into picture? So see, sorry. In this case, what will happen is, okay, when amalgamation will happen, all assets and all liabilities of this amalgamating company will be transferred to amalgamated company. So when all assets and all liabilities are transferred, current assets are transferred, liabilities are transferred, fixed assets are transferred, investments are transferred, but that means that fixed assets, investments, in other words capital assets are also transferred in a scheme of amalgamation. So capital assets transferred in the amalgamation scheme will result into capital gain liability. Now we are saying that amalgamating a company, for you this is not to be regarded as a transfer. For you capital gain is not taxable. The only condition that you got to satisfy is that this amalgamated company should be an Indian company. Capital gain is not taxable if the condition put up, the amalgamated company should be an Indian company. Now see, what does this mean? कि भाई if amalgamated company is a foreign company, let's say I'll give names so that you know every time we don't have to write the whole thing. Let's call this as X Limited and let's call this as Y Limited. If Y Limited is an Indian company, तो capital gain is exempt for X Limited, not to worry. But if Y Limited is not an Indian company, if Y Limited is a foreign company, so sir, that means capital gain is taxable for X Limited. Yes, correct. But when capital gain is taxable for X Limited, the next question that will arise in your mind is, okay sir, so how to calculate the capital gain? Very simple. Full value of consideration minus cost of acquisition. Now what is cost of acquisition? Cost of acquisition will be cost of that particular capital asset which is transferred in a scheme of amalgamation. What will be full value of consideration? तो जरा amalgamation imagine करो. When amalgamation will happen, the amalgamating company will give all the assets, all the liabilities including capital assets, and the amalgamated company will pay the purchase consideration. How will purchase consideration be paid? Purchase consideration will be paid in the form of shares. How do you calculate this purchase consideration? This PC purchase consideration is calculated, remember, net payments method, net assets method, and in that net assets method what did you do? We used to take each and every asset, each and every liability and find their value. Which value? Book value? Nahin. Realizable value, market value, NRV, fair value. So that means for this particular capital asset also some value to has been determined, some value has been taken for PC calculation. That means the full value of consideration will be that net realizable value or fair value of this capital asset at the time of amalgamation, at the time of PC calculation. and the difference between the fair value and the cost, this will be the capital gain which will be chargeable to tax. If amalgamated company is an Indian company, capital gain is exempt for amalgamating a company. Why is the government giving exemption? Don't you think it can recover a super duper amount of tax in this case? In a scheme of amalgamation, all assets, all liabilities will be transferred. So the capital assets that will be transferred, they will have a good value, they will have value running into crores. So the capital gain that we calculate like this will be a good reasonable amount. Government will get a good amount of tax. No, government is not worried or bothered about tax. Government knows, government is aware that when amalgamation happens, eventually amalgamation is done for cost reduction, cost benefit, achieving synergies. So in the long run, from the amalgamated company, it is going to get income tax inflow on the business profits. When amalgamation will happen, amalgamating company will give all the assets and all the liabilities to amalgamated company. What will the amalgamated company do with this? Use these assets and liabilities, do business, continue the business of amalgamating company, do business on profits, and on those profits government is anyways on a yearly basis going to get income tax from Y Limited, amalgamated company. So we want to encourage amalgamation. We don't want income tax to be an obstacle, to be a hurdle. So we are saying amalgamating a company, for you capital gain will be exempt. And there is another benefit that the government has provided. X Limited is my amalgamating company. Y Limited is my amalgamated company. Imagine somebody as the shareholder of X Limited. What will this shareholder do on amalgamation? When amalgamation will happen, X is closing down. So shareholder will surrender his shares of X Limited. These shares of X Limited will be surrendered, and as consideration Y Limited will allot shares to the shareholders. So now think, you are the shareholder. The cost of acquisition of these shares was 16 lakhs. Cost of acquisition of which shares? X Limited ka shares. Now on amalgamation, X Limited closes down. So you have to give up the shares, and you are getting shares of Y Limited whose market value is say 24 lakhs. So shareholder, in this entire bargain, you have a profit of 8 lakhs. You gave up shares worth 16 lakhs and you got shares worth 24 lakhs. But this profit is not taxable. Not taxable for the shareholder. Now if you analyze everything together, you might understand. Okay, it's a slightly smaller screen. I think this might be a bit better. See, as X Limited, amalgamating company, your capital, amalgamating company, your capital gain is exempt if Y Limited is an Indian company. And shareholder, for you also, surrendering your shares and getting shares as consideration of Y Limited is exempt. Goes without saying, कि हाँ भाई, this exemption will be available only if the amalgamated company is an Indian company. So here the condition is basically the same for the shareholder. Let me put down this properly. For the shareholder of X Limited, he is getting exemption in capital gains. He just has to satisfy that one condition that amalgamated company Y Limited is an Indian company. Now, this condition will be automatically either satisfied or not satisfied. If Y Limited is a foreign company, the shareholder who is agreeing to the amalgamation, who is doing voting in the meetings and who is agreeing to the amalgamation, Y Limited is a foreign company, the shareholder will have to pay tax. Y Limited is an Indian company, shareholder will get the exemption. But something very interesting put up here, very logical also actually. Shareholder gets only shares as consideration. So if you get shares plus money, shares plus debentures, shares plus something else, then exemption is not available to you as a shareholder. For shareholder of X Limited, if Y Limited is an Indian company and only, let me write this even more accurately, only shares of Y Limited are received as consideration. The focus being on the word only shares. Shares plus something nahi, only shares. Now, capital gain is not taxable for the shareholder. There is a court judgment, Gautam Sarabhai, which says if the shareholder gets shares plus something else, so the shareholder cannot get the benefit of the exemption, then the entire capital gain will be taxable. Remember, the entire capital gain will be taxable, not just the component of the monetary part. Nahi. The full transaction will be subject to tax. Now, for shareholder of X Limited, he has to satisfy two conditions. Amalgamated company is an Indian company and he should only get shares. Look at this thing. This is the last point that I'll discuss here. See, look at this example. Suppose there is a company, say Tata Motors. And Tata Motors gets amalgamated into, let us say, Tata Steel. So, Tata Steel, Indian company. So, for Tata Motors, capital gain is not taxable. Now the problem. Shareholders of Tata Motors Limited. There are two categories of shareholders. One is the general public. General public has some 40% shares. And one is Tata Steel Limited, which has 60% shares. अब प्रॉब्लम इमेजिन करो, प्रॉब्लम क्या होगा? टाटा स्टील लिमिटेड will allot shares to the general public, but Tata Steel Limited will have to allot shares to itself, because Tata Steel Limited, in very crude words, if you understand, is playing a double role. Tata Steel is the amalgamated company also, and Tata Steel itself is the shareholder also. Now, as per Companies Act, can you allot shares to yourself? Not possible. Problem is, condition number 2 is not satisfied. For a shareholder, exemption is available if the amalgamated company is an Indian company. Tata Steel is an Indian company, but only shares are received as consideration. Now the problem is, general public, you will get your capital gain exempt, but Tata Steel will not be able to allot shares to itself. So condition number 2 will not get satisfied. But this is an impossible condition to satisfy. You cannot satisfy this condition. That's why they clarified. They said, if amalgamated company is an Indian company, and second, only shares of amalgamated company are received as consideration, except if the amalgamated company is itself a shareholder. So if the amalgamated company itself is a shareholder, then you don't worry about satisfying the second condition. You just satisfy the first condition. That's more than enough. In this case, Tata Steel, don't worry, your capital gain will also be exempted. Public will get exemption because public will satisfy both the conditions. Tata Steel cannot satisfy the condition of allotting shares to itself. So because the amalgamated company itself is the shareholder, no problem. If the amalgamated company is an Indian company, which it is, Tata Steel as a shareholder, you will get exemption when this amalgamation event takes place. So this is 2 points that I have done with you related to amalgamation. Point number 1, amalgamating company gets the exemption. Point number 2, shareholder of amalgamating company gets the exemption. Point 1, condition is very simple. Amalgamated company should be Indian company, and in case of shareholder, there are these 2 conditions. Chalo, we'll call it a day here. Tomorrow I will continue with transactions not regarded as transfer. Tomorrow the first 1.5 hour of our discussion, 1.5 hour precisely, is something very difficult, something very important for CA final. In the past it has come up in your exams also as an independent 4 to 6 mark questions. So first 1.5 hour tomorrow is going to be a bit on the tougher side, a bit crucial. If you can just pay attention to that concept properly. Chalo, we'll call it a day here. See you. Tata. Bye bye. If you have found this video helpful, just give it a thumbs up. Subscribe to the channel and share it with your friends. All the best. See you tomorrow. Bye bye.